You're listening to the retirement architect, David Reyes.
We're talking about risk management today, and most of you do not have what I consider true risk management. And what I mean by that is, a typical 60% stock, 40% bond portfolio, even in 2008 was down as much as over 30%. That's not risk management. If you go into retirement, are you okay if you have $1 million in the market and you think you're all got your security blanket, which is your stock and bond portfolio that's 60% stock, 40% bond, and it drops 30%? I mean, that's are you going to be happy with that? Are you okay with that? Can you stomach that? But more importantly, why would you even want to have a portfolio like that? It makes no sense. I've done this for 20 years, and I've been through the 2000s, early 2000s, been through 2008. And I'll tell you, we just don't build portfolios like that because our clients, I've been doing retirement planning since 1995 and total wealth planning, including tax planning. My partner's a CPA, and estate, retirement distribution, investment planning, asset protection planning. And so, all I care about is you as a fiduciary, and I want to make sure that you have the proper information and knowledge. There's a saying that I've heard a long time ago, and I love it. We're drowning in information and starving for wisdom. And we really are. I mean, if it was so easy, just go on the internet and do this yourself. And it's just not possible. Social Security, is a very complicated issue. We teach on Social Security. And I'll be announcing our next workshop, which will be in September. We're still waiting for a date. But I do about 8 of those a year, and they're really, really well attended. But let me finish I want to give you, we talked before the break, if you weren't listening, about, one of the ways I wrote a paper on wealthmanagement.com a while back, and I just did a new paper for another major magazine that you'll get. I'll send a copy to people once it gets published on 60/40 stock to bond portfolios. But talking about risk management, the first line of defense is guarantees, okay? And I was reading the quote again from the Nobel Prize winning professor at MIT, Robert C. Merton, who said that risk should be defined from an income perspective and risk-free assets should be in deferred inflation index annuities. We're talking about really good index annuities that can give you good rates of return. I mentioned one was about 14% last year that we work with. Low fees in the 1% range, and predictable guaranteed income streams for both you and your spouse. And those are based upon the claims paying ability of the insurance company, so you want to work with really good companies. But I'm going to talk to you about I'm going to start introducing slowly, because it's something that most advisors and most brokers do not even get into because it is a complicated world and it takes a lot of knowledge and expertise that I've spent years on. And am certified through this Chicago Board of Exchange, and we're going to talk about this. But what if you could have institutional like risk management to your portfolios, like the big boys use? Okay, so think about that. Do you have most of you own a home, right? You own a home. Do you have homeowners insurance coverage? Yes. Do you own a car? Do you have auto insurance? Yes. Well, you pay a premium every year for that, correct? And whether or not you have a catastrophic event, either a major car accident or let's use your home burns down. I mean, that doesn't happen to very many people, even though we live in San Diego and we have the great Santa Anas here. In fact, we just got evacuated on the last little flare up immediately. I'm in the Forest Ranch area, and so my kids got evacuated from school. It was very scary. But the point is that think of the premiums that you pay for your homeowner's insurance. You're going to pay year after year after year. Well, what if, and you do that because just in case, right? Just in case you lost your house because you don't want to spend $500,000, $1 million, whatever your home is worth, out of your own pocket to do that. So what if we could do the same thing with similar thing to mitigate risk with your stock portfolio? Okay. We do this every day with our clients. So we build in protection inside of the portfolio. So we spend a little bit of money inside of the portfolio year after year that will protect the downside. To give you an example, one of our managers that we use to do this for us in '08 was down in a market that was down 37%, was down about 5%. In 2000 to 2002, when we had the internet bubble, the market was down a combined 42%. This manager was up over 20%. That's a difference of 60%. So let's put that in a real context. If you had $1 million portfolio, you lost over $400,000, while we gained in this hypothetical portfolio $200,000. You're talking over $600,000 worth of difference or delta or money. How about money? So we made money actually in a losing market. So if you want to know more about that, and I'm going to get into more details about this, I'm going to have some of my money managers on that we use these strategies with, and this is on the stock portion of the portfolio. I talked about annuities for the income side. This would be for the growth side of the portfolio. So if you're interested in that and you want me to do a second opinion, please feel free to give me a call, and I'll be happy to help you personally. I will help you, my partner and myself. 877-406-CALL, 877-406-2255. Again, 877-406-2255. You can always visit me on the web at reyesplan.com. And we do an email of the week, which I'll do this week as well. And if you have a specific situation that you want me to comment on, I will. So let's switch gears a little bit. And I don't want to cram this in, but I did want to at least talk about the other type of risk management that we do. And what I do want to talk about is what I call, the myth of the 60-40 portfolio. Because if you're near or in retirement and you have a traditional 60-40 portfolio, meaning 60% stock, 40% bonds, do you know that if you take out a 4% distribution rate according to Morningstar, that you have a 50% chance of running out of money before your retirement's over? I don't know about you, but those odds are horrible. I would never, ever, ever do that. And the problem is that most people don't realize the drawdowns or the losses. So I'm going to show you, in 2008, if you had a 60% stock, 40% bond portfolio, you were down as much as 30%, okay? During the bear market of 2000 to 2002, the internet bubble, you were down at 16, 17%. The stock market crash of 87, 18%. 73 to 74, bear market down 21%. The Great Depression, which, hey, don't ever think things like this cannot happen again. We were very close to one in '08, down 64%. So is that risk management? No. Remember, I told you we want to win by not losing first. You only need 30% of the upside of the S&P 500 if you can mitigate or eliminate the losses, and you beat the market. Not only do you do well, you beat the market. So we don't want to have our clients we don't design portfolios because our clients are in or near retirement to have these types of losses. Because first off, we care about our clients' mental health before we care about their wealth. I want my clients to be happy. My phone does not ring when the market drops. It just doesn't, because we have written plans for all of our clients, and we build portfolios that have true risk management. So to give you an example, in a 60% stock, 40% bond portfolio, 98% of the risk is in the equities. And so I just got done doing a paper, and if I don't get to finish it on this side, I will on the next side of the break, for a major publication. And I'm going to read you some of the excerpts from that. I'm trying to find it here. And I did a case study, and I did a report for them. And basically, here's an actual client. So the client was making while they're working $100,000 a year. They had $1 million in savings. Okay. They didn't have any debt, which is great. That was smart. And so what we did with their portfolio, they had a 60% stock, 40% bond portfolio. I just talked to you about all the losses that you could have with that kind of portfolio. And most of you think that you're protected with that, and you're not. That's the myth of that portfolio. They retired at 66, both of them. They had $1 million. We took Social Security at 66. They got $2,500 a month from Social Security for the Mr. Mrs. got $1,250. How we did the plan was basically we took Social Security at 66 in their situation. We're experts in Social Security planning, so each one is different. But of the $1 million they had in the portfolio, we kept $600,000 in stocks, and we took the bond side, which I think bonds are very risky right now, even though they've done well this year, and we invested that in a deferred inflation adjusted index annuity, just like my MIT professor said. Okay, Dr. Merton. And that produced an income for life of about $1,666 a month. So between the Social Security of $2,500 for the husband, $1,250 of Social Security for the wife, the annuity income of $1,666, they had $5,400 a month or $65,000 a year of income. Now, that isn't even touching the $600,000 of stock, which we're going to use. So we have the $5,400 a month or the $65,000 a year that we get to use for our basic needs. And now we have the stock portfolio left over because we want to plan to live, not to die. If you're going to have a 30-year retirement, we want to make money, and the only way to outperform inflation is through stocks. It's just been proven. And as you know, we talked about some of the risk management tools that we use for stocks. And so we're going to use the stock portfolio for their wants and dreams, vacations, helping pay their grandkids' college, whatever that is. So again, if you're interested in something like this and you want a portfolio that can produce income, that can give you growth, that can give you peace of mind, give me a call, and I'd love to help you. Again, we do workshops quite frequently here on Social Security and retirement income planning. And we will give out that information on the next show because I don't have the date here yet. But if you'd like to have me do a portfolio review, a second opinion on your entire retirement, give me a call, 877-406-CALL, 877-406-2255. Again, 877-406-2255. I'm also giving out to the first 10 callers a chapter of my book that I just wrote with Mr. Stephen Forbes, presidential candidate and founder of Forbes magazine. I was very privileged to be a co-author of that book, and I'm going to give you a chapter called The 7 Secrets of a Stress-Free Retirement. It's a great chapter. In fact, I'm writing a whole book around that's going to come out sometime the first quarter of next year. So if you want a copy of that, again, a copy of a chapter from the book Successonomics, written by Mr. Stephen Forbes, and co-authored by myself. Again, that's 877-406-CALL, 877-406-2255. On the last portion of the show here, I'm going to talk about a couple of different things, but most importantly, I'm going to read my email of the week. I get many emails. If you ever want to email, it's david@reyesplan.com, david@reyesplan.com. I return every phone call and every email personally. So again, this is David Reyes on AM 760 KFMB.